With 2024 coming to a close, now is the time to implement strategies to make sure you maximize your tax refund and limit your tax liability. In this video, I am going to give you strategies that you can implement right now to make sure that this happens. But before we jump in, I'm gonna need you to like, comment, and subscribe so you don't miss out on any of this tax information. Now let's get after it. Contributing to your retirement plan is mission critical. Many of you may think to yourself, I'm young, I'm not thinking about retiring. Or some of you may be thinking, you know what, I'm already getting ready to retire, it's too late. It is never too late. You always have today. Contributing to your retirement plan is mission critical, and you want to maximize your contributions if you can. If you work with an employer, you want to contribute to your 401k plan, your deferred comp plan. Why do I say that? Because most employers will match. So if you're putting in 2%, they'll put in 2%. You put in 3%, they'll put in 3%. They'll usually match your contribution up to a limit. Therefore, if you're not taking advantage of that, you're leaving money on the table. It is like your employer gave you $1,500 cash and you only took $1,000 off the table and left $500. So you want to make sure you utilize the 401ks and the retirement plans you have with your W-2 jobs. However, what if you don't have a W-2 job? What if you are self-employed? What if your job doesn't have any type of retirement plan? You can always make contributions on your own by creating an IRA, an individual retirement account. You could go directly to your bank, do it online, and set up an IRA. And if you can afford to max it out, whether it's $6,000, $7,000, or $7,500, max it out. But even if you can't max it out, put something in it. $500, $600, $1,000. That is going to lower your overall taxable income. You'll be thanking me later that you put that money into your retirement account and set it and forget it. The best thing to do is to put aside a small amount so you never have to think about going to go get it. Contributing to your retirement plan is so important. Harvesting tax losses is another great strategy that the wealthy use, the rich use, and you can use too. Let me explain what harvesting tax losses mean. If you are invested in the stock market, if you have any type of investment that you know is at a loss, you plan on selling it. If you sell it before year end, before December 31st, you can recognize those losses on your 2024 tax return. Don't wait until January. You want to accelerate your write-offs, accelerate your losses so that you can utilize them in the current tax year. So take a look at your portfolio, and by portfolio I mean your stocks, your investments. Take a look at your investments. If you have some losers out there, liquidate those losers before year end. And remember two things. You can take your losses against your capital gains. That's really important. And if you have losses that exceed your gains, you can take an additional $3,000 above and beyond your gains. So utilize harvesting tax losses as a strategy to increase your refund and reduce your overall tax liability. Charitable donations are so good for so many different reasons. Number one, charitable donations make you feel good. When I donate to organizations, individuals, whatever it may be, it is a feel-good feeling. So it really does serve two purposes. It's good for your mental health to be able to give back, but it's also good for your tax health. When you donate to charity, you can take that as a tax write-off. Now, yes, you have to make sure that you can itemize your deductions, that your itemized deductions are going to come above the standard deduction. But if you start to give away things to charity, you can aggregate them. You can stack them on top of each other. Give away one shoe one day and the next shoe the next day. And make sure you get plenty of receipts from the organization that you gave to so that you can take your tax write-off. Your charitable donations can be cash if you have it, but you can also donate in-kind goods, which include canned goods, include clothing, include electrical items, appliances that you are no longer utilizing. Something that you may not need may be someone's very want. Giving can help you reduce your taxes, and I highly recommend it, which is why I love to give, and I have my own organization, KDA Cares. Review your tax withholdings before year end. We know that we are all jazzed up around the holidays. The last thing we want to think about is our taxes. But I am going to tell you, my friends, take some time out right now. Yeah, I said right now, and review your tax withholdings. Where are you? Did you file exempt and you forgot to change it back, and now you don't have any withholdings? Do you need to pay in more? Get a grip right now so that come April, you're not crying come tax season. You're not owing Uncle Sam. You can certainly take it down to where there is no refund, and that's a tax smart decision that we'll leave for another video, but I don't want you owing Uncle Sam. So make sure that you take some time to review your tax withholdings, get with your tax professional, see where you are. If you don't have a tax professional, hit me up. I'm happy to help you, but we need to see where you are so we have no surprises before you spend all of your money on your holiday gifts. Utilizing your flexible spending account is very important, your FSAs. When you set money inside of your FSAs, that money is set in tax-free, meaning you're not paying any taxes on that money. But you want to make sure that you utilize the money and you don't leave any money that you're later on going to be taxed on. Some websites, for example, Amazon, they have an FSA and an HSA website where you can purchase things that are going to qualify to utilize those dollars. Having a flexible spending account is really important. You may think, well, they're taking my money, but I want you to start thinking differently, because this is how the wealthy and the rich people think. They're going to always set money aside tax-free. Yes, it's money coming out now for you to utilize later, but you gotta increase your tax smart and start thinking long-term versus short-term. So we talked about contributing to your retirement account. We talked about giving away dollars to charity, and that's a feel-good moment. We talked about using your FSA accounts that are flexible spending accounts. We talked about checking your withholdings before year end. We also talked about making sure that we harvest our tax losses before December 31st. And you already know, once you know better, you absolutely have to do better, which is why I want you to like, comment, and subscribe, and share this video with a friend. Why? Because friends do not let friends overpay their taxes.